Good morning, everybody, and welcome to another edition of Personal Finance Friday. Today we're talking about investment glide paths and what they might mean to you. We'll be right back after this. And we're back on Personal Finance Friday, where we're talking about investment glide paths. Now, we first used this term in reference to the target date funds that we mentioned in a previous video. And the things that go in with an investment glide path are two things: your time horizon and your asset allocation. But where does the term glide path actually come from? Well, the term actually comes from the aviation industry, and it describes your rate of descent in the airplane over time as you're coming in for a landing. So, I mean, it sounds very, very easy, but take a look at what that actually looks like from an illustration perspective. Now, as you're flying along, early on in your flight, you're up as high as you go, and your altitude will change over time as you come in for a landing. That's your rate of descent over time. But from an investment perspective, what we're talking about is your asset allocation, which is how much you have in equities versus how much you have in fixed income. That's stocks and bonds, and how that changes over time. Now, when it's very early in your career, when you're first starting out, because your time horizon, the time between the time you invest the money and the time you need the money, is so long, in this illustration we're looking at 40 years from age 25 to age 65, you can afford to take a lot of risk, which means a high allocation in equities. But as you get older, that should come down and increase slowly your asset allocation towards fixed incomes, toward bonds. And that asset allocation is that mix, that 70-30, 80-20, whatever it happens to be, that's age appropriate for you. So a look of that, sort of in a stair-step fashion, is that same glide path. It's the change over time in your asset allocation that's appropriate to your age. Now that's really all that's meant by the glide path, and it's that from the time between you start investing, and hopefully that's early in your career, to the time you need the money, how that mix will change. Now, in a target date fund, that glide path is specified by the fund managers, by the company that creates the funds. And the date that's associated with that target date fund will give you some indication of where the asset allocation is. But the prospectus will tell you the actual mix. And of course, you can go check a quote on it at any time to see where it is on that particular day. But if you look at, say, a target date retirement fund that's 2035 versus one that's 2055, you're going to notice a very different asset allocation from stocks to bonds in those, because the target date time horizon of 2035, you're closer to its termination point, and therefore your assets, your asset allocation in equities will be lower than it would be in the one that's 2045 or 2055. There'll be more in equities in those because the time horizon is longer. So that's a simple, quick explanation of glide path in investments. It's most commonly used with target date funds, but it actually applies to all investors. So that's it for today's episode. Have a great weekend, everybody. We'll see you next time.